holders of resources, and business activities. Now, so what accounting does is to collect data, analyze it, and generate financial information, which is communicated to the users for them to make an informed decision. Now, so if you look at it, when a transaction happens, there's data collection. And the data collection, one of the key means of collecting data is to have a document that authenticates the transaction. And accounting will refer to that as source documents. Okay, can somebody give us an example? We're just recapping what we did last week. Can somebody give an example of what a source document is? Yes, George.
Please, Jonah.
Okay, Lydia.
Receipts of transactions.
Receipts, great.
Yes, please.
Abigail.
Invoice of transaction. Invoices. How big invoices?
Okay. Okay. Now, so if there's a transaction that you don't have a soft document, how can you authenticate the transaction?
Oh, please, the question again.
That you have entered into a transaction for which you have to account for, but you cannot get any of the source documents that we have mentioned. How will you go around it? Yes, Andrew.
So please, I think it's almost impossible to do that because you may not have any records to prove.
Yes, Lydia.
And when auditors.
Yes, Lydia.
Sorry, it's a previous hand.
Okay, so please lower your hand if. Yes, Clement.
Yes, please. Can we use ANA certificate? ANA set.
Okay, great. What is that one?
Okay, the ANA set is used when there is a transaction and you cannot obtain the receipt. Like when you buy someone, they can't give you the receipt. Or there is a service provider who cannot give you a receipt. So the company prepares an asset and then the client or the person is doing.
All right. Okay. So you are saying that you are an honorable person. So what you are saying is true. Is that the case? Is that the case? Okay. Now, so the next is to try and analyze the transaction, and you will now record in a book of original entry. We mentioned examples of books of original entry. Can you give us an example?
Sales day book.
The sales day book. Okay, very good. What do we use the sales day book for? Yes, Benson. Please, if you are not asking question or answering question, you have to mute yourself. I'm going to remove people from the class. Yes, George.
Please, the sales day book is used to record daily transactions of an organization. Daily sales transaction of an organization.
Okay, any others? Bismarck.
So the cash book.
So we're talking about the sales day book, what it's used for.
Sir, it's used to record the sales made
so all sales
made for the day.
All sales.
All sales.
All sales. Yes, Belinda.
Purchase day book.
We haven't. I'm still on the sales day book.
Okay. The post day book is used to record daily sales in the organization.
All sales.
Yes, please.
Yes, Belinda. Somebody wanted to make an intervention.
Yes, sir. Please, it was me. It's used to record goods sold on credit.
Okay, so it's credit sales. Remember that it's credit sales, not all sales. Very good job. Okay, now so when we have recorded in books of original entry or prime entry, now we post into the ledgers, which we refer to as the books of accounts. And can you give an example of the ledgers? Yes, Steven. Randy.
The sales ledger.
The sales ledger. Okay. Now, included in the ledgers will be the cash book. So the cash book is also a ledger, or it's a book of accounts. But if you recollect, we said that it's also a book of original entry. Why is the cash book a book of accounts or a ledger and at the same time a book of original entry? Do you understand the question? Hello?
Sir.
Yes.
Because it serves as a debit and a credit book at the same time.
It says as debit
and credit. It records debit and credit sales.
We're talking about the cash book. Yes, Anne.
Is the first book used for an entry of? Sorry, let me rephrase that. Is the first book used for recording with the bank and then the cash, and also for recording cash transactions? That makes sense.
Okay, so the cash book is a book of accounts, because anytime we say that it's a book of accounts or a ledger, then we are saying that we obey double entry. So there is a debit and there's a credit. Okay, there's a debit and there's a credit. So if you look at the cash book, we have a debit column, we have a credit column. That's why, so if you look at all the ledgers, you have a debit and you have a credit. But when we look at the cash book, we can have a single column cash book, and here we are talking about only cash transactions. Then we can talk of a double column cash book. Here we're talking about bank and cash transactions. So that's a double column. So we subdivide the amount column into two. Then one section, it will represent cash, and one section will represent bank. But we'll still obey double entry. However, we can also subdivide the amount column into three. So we have a 3-column cash book. Now, when we divide it into three, and we are saying there is a 3-column cash book, the third column is used to record discounts. The third column is used to record discounts. But that third column, we do not obey double entry. So one section is used to record discount allowed, and one section is used to record discount received. Okay, so because, and if you recollect, when we talk of the debit, we are not obeying double entry. So once we are using to record discount allowed and discount received, then we call that as a day book, because we are not obeying double entry. So that's why the cash book is described as a book of account or a ledger at the same time a day book. Okay. Now, so once we've recorded in there or we posted into the ledgers, the next is to test the or we'll now determine the balances. And if we determine the balances, we'll now have to test the arithmetic accuracy of the postings. And we'll test the arithmetic accuracy of the postings by extracting the trial balance. So once we extract the trial balance, the next is to now prepare and interpret the financial statements. Now, so this is the cycle that we going through. Now, yes, and you have your hands up. Is there a question or comment?
Sorry, I've lowered it.
Okay, all right. Now, so if you recollect, we said that the cash book, we can have a 3-column cash book and we can have a 2-column cash book. But whether we having a 2-column cash book or a 3-column cash book, we have a section for bank and we have a section for cash. Now, the section that we have written cash, it means that cash is with us. Okay, that's cash is with us. Now, you recollect that when we're looking at the assets, we said that cash is an asset. Do you recollect that? Do you recollect that cash is an asset?
Yes, please.
Okay, so when cash is increasing, what do you do to the cash account? When cash is increasing, what will you do to the cash account? Remember, we gave you a summary of the double entry. When an asset is increasing, what do you do?
You increase.
Debit the asset account.
We debit the asset account. When an asset is increasing, we debit the asset account. When an asset is decreasing, what do? You credit the asset account. Hey, my friends, are you there? So, anytime asset is increasing, we debit the asset account. Anytime an asset is decreasing, we credit the asset account. What about for capital or equity? When capital or equity is increasing, what do?
Credit the capital account.
When capital is increasing,
Credit.
they will do what?
Debit
asset.
Oh, my friends, you collect that the accounting equation assets equals to equity plus liabilities. So what you do at the debit is the opposite at the credit, or the other side, the right hand side. So if an asset is increasing, you are going to debit it. If equity or liability is increasing, what will you do?
You credit the liability.
Credit it. You guys are good, so don't give me at it this morning. Okay, so when liability is decreasing, what will you do? When liability is decreasing, what will you do?
You credit liability.
You will debit.
Debit.
Okay, right. Great. Okay. Now, so if we go back to the cash book that we're talking about, we're saying that we have the left-hand side, which we may call as debit. Then we have the right-hand side, which we may call as credit. And remember that cash or bank is an asset. Now, the debit side that the debit side of the cash book, we can also record it as receipts. and we can designate the right-hand side as payment. So anytime we receive cash, we'll debit the cash account. Anytime we receive a check, we'll debit the bank account. But anytime we write a check, which is a reduction of the amount in the bank, we will credit the bank. Similarly, if we take money from the till, we will credit the cash account. Am I making myself clear?
Yes, please.
Okay.
Sorry, can you please repeat yourself?
I don't repeat myself. If you ask a question, then I'll answer the question.
Okay, sorry.
I don't go over.
When you said check the check side, when you said when you write a check.
Yes. So if we receive a check, that will be an increase in the bank account. Do you agree to that?
Yes.
Okay. So if we receive a check, then we'll debit the bank account.
You are debiting the bank account of the person who brought the check, right? That's what you mean.
No, in your books, you are debiting it. You are debiting it because when the person brings the check to you, assuming the person is owing you, if they bring the check to you, you debit the bank account and credit their account.
Right.
Okay. So then we would have completed a double entry. Okay. Now, so when we issue a check, it's a reduction of our cash at the bank. You agree to that?
Yes.
Okay.
Yeah.
So because it's a reduction and it's an asset and it's decreasing, you will credit the bank account.
Okay. Right. Okay. Thank you.
Okay. All right. Now, so what we're suggesting here is that anytime we issue a check, we will credit the bank account. Anytime we receive a check, we will debit the bank account. Anytime we receive cash, we will debit the cash account or the cash column of the cash book. And anytime we give out cash, we will credit the cash column of the cash book. Is that okay? Now the difference is that when we receive cash and we debit the cash account or the cash column of the cash book, that money is in your premises. So anytime somebody brings you cash, that money is in your premises. And if you have to pay out cash, you are taking it from the till and giving it out. However, when it comes to the bank transactions, when we receive the check, even though we are debiting it in our books, the check must be sent to the bank. Do you agree to that? So when we receive a check, the check must be deposited at the bank. Is that okay? So that money is not with us. So when we debit our account and send it to the bank is going to credit our account. Hello? Okay, so when we receive a check and we debit our cash book or the bank column of the cash book, we'll now deposit it at the bank. And when we send it to the bank is going to credit our account of having received resources from us. So if you look at it, it is different. Because when we're talking of the cash column, that money is with us. But when we're talking of the bank column, that money is not with us. It is bank. Now, to ensure that we are at the same page, the bank will periodically send us statements. Have you been receiving statements? A bank statement?
Yes.
Okay. Now, so when we receive the statement, what you have debited in your books, the bank would have credited you. And what you have credited in your books, the bank would have debited. So when you issue a check, which is a reduction of your assets, you will credit your cash book. Okay? But when you send it to the bank will now debit your account. So when you receive a statement, you see that all things being equal, the items at the debit column or the bank statements may coincide with the items at the credit column of your cash book. Then the items at the credit column of the cash of the bank statement will coincide with the items at the debit of your cash book. So if I receive a check and I debit my account because it's an asset and it's increasing, when I send it to the bank will credit me. So when they issue a statement, what I have put there as debit in my cash book, the bank would have credited me. So it's a mirror. Yes, Godwin. Yes, Godwin.
Yeah, I forgot my account. But I remember we had this simple golden rule of thumb we used to use back in school. Debit the receiver, credit the giver also. I don't know if you can do that to explain to us.
No, so that I've explained to you that is the theory of double entry. And it's a difficult concept for you, a lot of you to appreciate. So if we do that, we'll confuse ourselves. That's why we are using accounting information. Yes, tell me.
Doc, I want to ask that from the layman's understanding, I understand that when we debit, it means there is an increase in the resources. And when we credit, rather, there is an increase in the resources. And when we debit, there is a decrease in the resources. So I want to ask whether that is applied in this particular situation that we are considering debit and credit.
Okay. So you see, that's why we try explaining to you the accounting equation. So we have to come back to the accounting equation. Okay? And if you recollect the accounting equation, we said that assets is equals to capital or equity plus liabilities. Okay. Now, what the question that somebody asked that we should debit the receiver and credit the giver. If you're unable to identify the giver or the receiver, then you are stuck. But what you need to appreciate will be, is this an asset? Is this a liability? Okay? So long as you can identify that this is an asset or this is a liability. If it's an asset, anytime the asset is increasing, you debit it. Anytime the asset is decreasing, you credit it. So when we take the assets, we say that, I will give examples. One of them was cash. One of them was bank. So you don't need to understand the mechanism involved. All you know is that if cash is an asset, if it is increasing, you debit it. Yes, Calvin. Yes, Calvin, you have your hand.
Earlier hand I raised, I'll lower it.
Okay, all right, sir. Now, so I'm bringing you to the point that you need to understand that cash and bank are assets. Okay? Cash and bank are assets. So when bank is increasing in your books, you will debit it. But when you send it to the bank will rather credit you. Okay? So it's the opposite. So when you send the money to the bank will credit you to show that there's an increase in your resources with them. But when you issue a check, the bank will now debit you because it's a reduction of your resources at their end. But in your books, because it's an asset and it is decreasing, you will credit it. Okay. Now, so the challenge is that if you receive a bank statement, if the bank has been recording their transactions as you should, and you have also been diligent and you are recording your transactions as you should, then the bank statement balance should agree with your cash book balance. I.e., if the bank says that I have 10,000 cedis with them, in my cash book, I should also show that I have 10,000. But rarely will you see that the bank balance will agree with the cash balance. There could be some discrepancy, so that when you receive your bank statement, your cash balance as per the bank statement will differ from your cash book balance. And that's why you have to do what we call a reconciliation, a bank reconciliation. So today we're discussing bank reconciliation. And bank reconciliation simply is agree two positions. So you identify what has caused the discrepancy, then you try to agree the two positions. So we're discussing bank reconciliation. And these are learning objectives. First, we'll have to look at what are the causes of the disagreements between the cash book balance and the bank statement balance. I've already explained to you that rarely will you find the cash book balance agreeing with the bank book balance. So when you receive your statement, there could be a disagreement between cash book, the balance aspect of the bank statement, and the balance aspect of the cash book. Now, so if you are able to identify the causes of these disagreements, then we'll now identify how to agree the two positions. And agreeing the two positions, first, you may have to adjust your cash book to reflect on transactions that the bank has recorded, for which you have not done, and you should have done. Then you now prepare what we call okay. So once you keep on interrupting the class, I'll remove you from the class. Okay, so now let's look at the causes of the disagreement. Now, basically, there are two main causes. We have what we call timing difference and two informational difference. So the causes of the disagreement are either timing in nature or informational in nature. We say that it is timing because there's a lag between when you record your transactions and when the bank records this transaction. So in between the period, if a statement is issued, then there could be a discrepancy. So if there's a transaction that the bank recorded on the 5th, but we have not recorded, and on the 5th we issued a statement, then there could be a disagreement. So there's a timing difference. Okay, so the cause of discrepancy could be due to timing. Then two, it could be informational. Information in the sense that there could be some transactions that one party does not have the information, but the other party has gone ahead to do the recording. And because if you knew you have recorded, it could bring a discrepancy. So there are two main causes. We're talking of a timing difference and informational difference. Now let's look at those differences.
Oh, boy, sorry, please. I didn't know. Very sorry.
Okay. Now, so the timing difference, I've explained to you that where transactions are recorded, the other party will eventually record it or will effect a change, except that there's a lag between when one party records it and the other party also records it. The first one has to do with what we call unpresented checks. We call unpresented checks. So here, when you have drawn checks or you have issued checks, but the checks have not been sent to the bank. So when you issue the check, you record in your books that I've issued this check. So you know that your money has reduced. And you give it to your client, and your client might not have deposited it at the bank. And because they have not deposited it, even though you have reduced your balance, but the bank will not have reduced your balance because the check has not been presented to them. Okay, so but anytime the check is sent to them, they will do the recording. So that's why we're saying that it is a timing difference. So refer to them as unpresented checks. Then we have uncredited checks. So here we are looking at where you have received a check. And at the beginning, when we're looking at the recording of transaction, if you receive a check, you will debit your account. You recollect that. You debit your account. Then the check must now be sent to the bank for the bank to credit your account. But if you have either not sent the check to the bank, or the bank through their routines have not credited your account, then if a statement is issued, there could be a discrepancy. So here we are looking at checks that have not been credited to your account. Sometimes the checks are received, they record them, they have a lazy cashier and say that I'm piling them up to send. So in between the period, if a statement is issued, then there could be a discrepancy. Then we can also have situations where there may be errors. And here we are specifically looking at errors by the bank. Errors by the bank. So the bank may make an error. And once the error is made, eventually they will identify and correct it. Recently, I did a transaction with the bank. And before I could say Jack, they were crediting my account every second with 1,000, 1,000, 1,000. So before I could say Jack, my accounts had been credited with 106,000. So when I identified it, they had credited me with 75,000. So I called the manager and said, well, is there a problem with your system? And he said, he was asking me when I said, you have been crediting my account. And now you have credited me with 75. Also, we are calling the IT. Before the IT could resolve it, they have credited me with 106,000. So this is an error by the bank. So if I decided that, it's a windfall, and I'll go and cash it, eventually the bank will identify this error and correct it. So it's a timing of the correction. So that will be a timing difference. Sometimes students will also ask, what about errors that you have committed yourself? So if you commit an error, you don't wait till it's time for reconciliation before you do the correction. Anytime an error is committed and it's identified, you go ahead and correct it. So we usually don't talk about errors that are committed by the company or the entity itself. So these are the timing difference items. So one, there could be unpresented checks. Two, there could be uncredited checks. And three, there could be errors. And here we are specifically looking at errors by the bank. Any question? Okay. Yes, Bismarck.
Thank you, sir. Sir, please, is there any exceptional case whereby the errors wouldn't be identified till the statements are in?
Yeah, so what we are saying is that, so when the statements are in, they will not have identified the error. And that's why there's a discrepancy. We are looking at the causes of the discrepancy. And here we're saying that there's an error. And because there's an error, there's a discrepancy. But what we're saying is that it's a timing difference. Because eventually, the error will be identified and corrected. But it is when the error is identified and corrected. That's why there will be a discrepancy. So there will be a time lag between when the error is committed and when the error is identified and corrected. Yes, Emmanuel.
Thank you.
Okay. Good morning, sir.
Yes, good morning.
Please, I know we are discussing the causes, but I want to be clear. What's the acceptable length of time for the discrepancies to be corrected?
But corrected by who?
By either the bank or the one doing the cash book.
No, for many companies, it's a policy. Some may be doing daily reconciliations, especially if they have real-time information. Okay. For some of them, it could be weekly, but most businesses do it on monthly. But by practice, many banks send statements on monthly basis. So you should clear or you should prepare a reconciliation statement on monthly basis. But as I'm saying, if you have real-time information, so some businesses can't have that access, and therefore they have to do constant reconciliation. Yes, Peter.
To explain the uncredited check for me, I didn't get it so well.
Sorry, I didn't get it.
Yeah, the uncredited check.
Uncredited check.
Yes, complete through more.
All right. So here we are looking at where you have received a check.
Okay.
Okay. Then you send it to the bank. Give me a second, please.
Okay.
Okay, sorry. So we're talking about uncredited checks. So if you receive a check and you send it to the bank, what should be the credit time?
24 hours.
24 hours. So the banks, do we have people working in the bank? They will say that if it's house, then it will be 24 hours. So sometimes you receive a check, and instead of them giving you an instant one, they won't give you instant one.
Yeah.
Okay. Now, so if I receive a check and I send it to the bank, and they are saying that it's going through the clear process, when I receive the check, I will record it in my books that I have received this money. So my bank column will go up because I've received a check. But if I send it to the bank and the bank has not credited my account because it's going through the so-called credit system, if they issue a statement before the credit is made, then there could be a discrepancy. And we're referring to that as uncredited check.
Oh, okay.
Is that okay?
Thank you. Yeah. Thank you.
Okay. Sometimes you may have, as I was mentioning to you, a lazy cashier. And all they do is to pile the check up and say that I'll send it over the week, Friday. Meanwhile, they have recorded it in the books as having received the checks. So your account should not be credited with that. And that will cause a discrepancy. Yes, Anne.
But with the checks, sometimes, for example, with cross banking. I mean, when you take another bank's check to your another bank to cash it, there's it's possible that the bank might delay the payment of that check. So that's also not just the cashiers. I won't say that's also a delay of.
You're a cashier.
I'm not a cashier. I'm just saying the way you keep on saying lazy cashiers.
Don't worry. Okay. All right. But essentially, what we're trying to say is that your account does not have value for the check that you have recorded in your books, and that is causing a discrepancy. Is that okay?
Yes, it's fine.
Okay, all right. But you see, the if it's across bank, the system for credit now it is daily. So
no,
it's daily. So why must
it takes about 2 days. It takes about 2 days or even 3 days. 3 days.
That's what I'm saying. Yes. It's the banks, they can't show prosperous, they don't respect us. Because you see, when they receive it, they're supposed to scan it and send it. And once the other party accepts it, it should be given value. Anyway, so those are the timing difference items. Then we have informational difference items, and they include charges. And here we're saying that informational difference because you don't have the information, or you may even have the information, but you want a confirmation from the bank. And because of that, what the bank has done, you may not have that information, and therefore there's a discrepancy. But if you had information, you would have done same as the bank has done. Now, first of them is charges and interest. Charges and interest. So the bank supposedly are providing us with services, and because of that, they charge us. And now, even when they charge you, previously, when they charge you, they will send you a note that you have been charged for so and so and all that. Now, you only discover when you receive your statements. So sometimes you're thinking that you have so much at the bank, but it's going through charges and interest. But must the bank charge us anyway? Should they charge us? Yes, Anne.
Yes. But these charges, for example, see, there are some accounts, like maybe current accounting, that warrants the charging. But for savings account, what I know is that there are no charges apart from maybe when you're going to do your ATM card, that probably they take something small from it or something. But
something small.
But either way, I'm just trying to say the charges are the customer is told. I don't think they'll just get up and charge you without you being told that you are being charged. If you don't know you are being charged, probably maybe your alert doesn't work or your email something. But well, from the bank I am with, probably that's what they do. And probably your bank doesn't do what mine does. So,
but what I'm saying is they charge us. They charge us in the first place.
No. I mean, for everything there's a cost. So if that it's just that it should be reasonable, but for everything
there's a cost.
Yes. There's a cost for everything. So
yes, Stephen.
But I think I have been thinking about this issue for long because we deposit our money and they turn out using our money for their various businesses and transactions. So on my layman, I don't see the reason why they've been charging us.
Okay. Yes, Benson. Yes, Benson. Should they charge us? Matilda.
Yeah, please. My bank, they charge me for electronic banking services every month. And I think they should charge because I think that is the money they use to maintain their IT systems that they use to send us the messages.
Okay. Manan.
Dog, I was saying.
Dog, I believe they should charge us because they are keeping our money for us. Monies that we know if you are saving it in your room or close to you, there's high possibility that you can go into it anytime. And then it's not safe. You can get missing too. People can come in and steal. So while they are keeping it safe for you, they should check something for saving it, keeping it safe for you.
Well, who said that they are keeping it?
But even if they are using it for something, whatever be the case, if the money ends up getting locked in what they are using it for, they'll still have to repay. So it's a risk they are taking with your money. But at the end of the day, if there's a loss, that's not part of your business. You still have to credit your money when you need it.
Yes, Peter.
Charges, but then the charges are too exorbitant. It's like, looking at the number of customers they have and charging 5 CD per customer for e-transaction is just too much. So at least they can charge, but then not that much. Thank you.
Okay. All right. Yes, Benson.
Oh, I was saying they shouldn't have charges because it's like you establishing a sole proprietorship business. Then you want in for someone's money to embark on your business. At the end of it, the profit will come to you. Meanwhile, you have charged the person too for giving you his money to run your business. I think it's a cheat. Thank you.
So I agree with you. In fact, it is even immoral. It's immoral. Because, you see, you are saying that they are keeping your money. Who said that they are keeping the money? They are trading with the money. They trade with the money. So I bring my money to you, you trade with the money, make a profit on it, and you charge me for using my money to make profits on my money.
But then they are giving you interest as well. So
which interest?
I mean, there's some account.
Okay, depends on the type of account.
Exactly.
If you have an account, a so-called savings account, look at the interest, the spread.
Something meager
as interest, and what they give it to you as interest. It's immoral, my friend.
Sometimes you'll be having 10,000 in your account, you'll be giving you 20 grand and all sorts of methods. And they have been trading with our money on a forex.
Yeah. So, but I guess there are some working the bank. That's where they butter their bread. So they will defend them. Okay. So you see, there's a bank. My wife and I opened an account with them, and we wanted an account that it would be difficult to even cash from. You know where we went to?
Where EcoBank?
No, EcoBank. So there are some banks that if you go to the banking, it's so difficult to even cash. There's a long queue, blah 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 blah. So when you have money there, because of the The frustration. You didn't go to go and catch the money.
GCB.
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 I haven't said anything. So, and you know, the account that we opened a savings account, and there was some issue that I was so curious about. So I decided that I will not bother operating the account again. But we have some money in there, and every month they will send a statement, interest, 4 cedis, products minus 5 cedis. So every day the money is going down. By the time we realize everything,
all the money is finished. It's true.
You see. So if because of the charges and interest, you may not have that information. If you had that information, you would have gone ahead to record in your books. Okay. Then we have standing orders. What is a standing order? And what's the difference between a standing order and direct debits? Yes, Lydia.
Yeah, a standing order is whereby you give the bank an order to maybe deduct some amount of money to make payment, for instance, to your insurers at the end of every month. Yes.
Okay, but so what's the difference between that and direct debit? Or let's Siba.
Yes, Prof. As she explained, that is direct debit, whereby you give the direct debit, the one my lady explained. But the direct, what's the name?
Standing order.
Standing order is when you give a directive to the bank to be paying maybe an amount to an account or someone in a period of time. Every month a payment should be going. Probably I might say my workers, I pay them this amount of salary. So I give the directive to the bank that at every month, this is the amount that is going to this very account. So that is a direct order. But direct debit is more or less, I don't know how to explain it, but it's similar to that of the standing order, but a little different. The difference.
What's the difference? That's why I asked you.
Okay.
Yeah, Abdul Manan. Your line is breaking. Yes, Ebenezer.
I want to.
Please, your line is breaking. Ebenezer.
I want to believe that a direct debit is an instruction you will give to a third party to have an account. And the standing order is an instruction.
We didn't hear that.
And with the standing order, okay.
Yes, Ebenezer.
Yes, I want to believe that a standing order is an instruction you give to your bankers to have a recurring amount deducted to a third party, and then a direct debit is an instruction you give to a third party to have to be able to have access to do a debit transaction on your account.
Sorry, I'm not sure I understand what you said. Yes, Ebenezer. Or somebody else.
That's my hand is up. Hello, Doc.
Yes.
Doc, I think direct debit is giving a company or an entity to take an amount from your bank account on a agreed date.
Oh, yeah.
They're giving an instruction to your bank to pay.
You give bank accounts, an account to the bank to
Okay, so Anne.
With the standing order, basically they are taking money. It's an instruction that is given by you to the bank, but that one has intervals. And I don't know, you specify when you want the money to be taken out of your account to whoever or the other account. So that one, there's intervals, maybe weekly, monthly. The direct debits is just you giving an instruction that money should be taken out, or yes, I think that's the way I understand it.
Okay, so you are saying that for direct for standing order, there's a specific amount.
Yes, and a specific interval or time to be sent out.
Okay. Okay, so I'm giving it to you as an assignment. So please read on what a debit is. All right. So the standing order is an instruction from you, but we keep on saying that the bankers, they become so prosperous that they don't even respect your instructions. So even though the instruction is from you, you may decide not to do it until you see that they have honored your instruction. So that could be an informational difference item. Then we can also have dishonored checks. Dishonored checks. What is a dishonored check? And what are the conditions under which a check may be dishonored? George.
Yeah, no, please, a dishonored check is a refusal of a bank to pay, to give an amount of money to a payee for reasons such as where the amount in figures may be different from the amount in words, where there are insufficient funds in the account, and where there are legal orders, where a court may give an instruction that the bank should not pay such amount to the payee. Thank you.
Thank you very much. Any others? Ebenezer.
So to add to what one colleague just said, I think that in some cases too, a check ended because the account from which the check had been issued, there's a garnishee on that account by a court of law. It would also mean differences in
the garnishee.
A garnishee is an order from the court prevent seizing the closure or asking that no money should be taken out of that account for any the directors of that company. They have it could be a debt they are owing somebody, and for which that the account no money come out of the account.
Okay. All right. So we are now looking at the condition under which checks may be dishonored. John.
Yes, please, sir. A check could be dishonored if the signature on the check does not match with the specimen that the bank has in their system. They can bounce that check too, please.
Okay. So when there's a discrepancy in the signature.
Yes, please.
Okay. Yes, Siba.
That's wrong.
Yeah.
When there is a mistake, maybe a deepening of the writings on the check without the person signing to endorse it. When it's also a postdated check and is sent before the date, the check can also not credited.
Okay. So, what about insufficient mandates? What is it?
Sure, that is to say, maybe if the signatures are 2 and one person is the only person who has signed, leaving the other person, is also the bank has the right to not to honor that check.
Okay, so if we are asked to provide at least 5 bases that can be described as insufficient mandates, what would you say?
5 bases?
Yes.
Please, Prof, I didn't get the question.
Yes, 5 situations that you may describe as insufficient mandates, for which a check may be dishonored or a bank refuse the payment.
That is, first one I would say, the bank is that of a club that has memorandum that states that all signatures must be present. And you don't have the likelihood to have, if one person is not availing himself, the mandate is not enough. That is one. 2, when the signatures too, when one person has signed instead of 2 people, that is also another case.
But it's similar to the one you described.
So you can have a case where all of them will sign, but the presence, you don't have one person present at the bank to help you. What's the name? To help the bank under your check.
Must all of you go to the bank before your check?
So there are certain clubs account where the memorandum has stated that all 3 parties have to be present at the bank before the cash is given out, probably in their constitution. So that is also a clause that can force the bank not to honor the check.
Okay, all right.
Yes, sir. I also think if there's some cancellation of figures on the check, that's insufficient mandate.
Cancellation on the check.
In the amount stated.
Okay.
Perhaps if it is 10,000, you've written 100,000 and you've cancelled 10 and also if there's some discrepancies. For instance, you are writing 1,000 and you cancel that one, you write 10,000 and the figures is also different.
So that is also insufficient mandate?
Yes, please.
Okay. Any others?
But I think when there is overrating.
Is what?
When there is overrating of the figure.
But what is mandate? What is mandate?
The right to the signature.
Sorry?
Authority. Mandate is authority.
Okay. Is the authority or?
Yes, authority.
Official order.
Okay.
Official
at what point do
authorization.
you say that the instructions is insufficient? Yes, Bismarck.
So please, when the customer does not sign the check or endorse, and also not endorsing the check with his signature, that makes it insufficient.
Okay. Then what again? Okay, so I'm asking you because in the time pass, we've asked questions. So to describe 5 situations that you can say that there's insufficient mandate.
But I think if the date is not mentioned or written correctly, or the date is mentioned of maybe 3 months before the mandate.
So, yes, I'm listening to you. Yes, Francisca.
I also know that sometimes if somebody writes you a check, the bank would normally have to either call or inform the person if whether or not they should honor the check, and if the person decides otherwise, that that doesn't authorize the bank to issue the money to you.
So that one, is it a withdrawal of mandate or insufficient mandate?
I'm saying so insufficient mandate plays here because if they don't have the person's authorization, they can't issue the money to you.
Okay, all right. Abibatu.
Yes, I was going to talk about the dates on the check that if the date on the check doesn't correspond with what they know of, they are giving you a check, you leave it for long before you submit it to the bank. Sometimes the bank doesn't.
So when the check is stayed?
But stays with the benefit. Yes.
So what period will the check become stayed?
When? Hello?
For what period would the check become stayed?
Say please after 6 months.
Okay, right. All right, so other situations where you may describe as insufficient mandate. In certain businesses, they may have different classes of signatories. So they may have a class A signatory, or class A signatories and a class B signatory. And the instruction could be that there should be one from each of the classes. So if a check is issued and the signatory are from both class or are from just one class, then the instruction will not be sufficient. There could be situations where are you able to mute your microphone? There could be situations where the business may designate one as a principal signatory. So the principal signatory must sign at all times. So even though they could say that 2 people should sign, but the principal signatory must sign at all times. So if 2 other signatures are on the check, but the principal signatory is not, then that could also be insufficient mandate. So there could be a number of situations where the situation may be described as insufficient mandate. But remember that insufficient mandate is one of the reasons for which a check is honored. So if in an exam you are asked to talk about insufficient mandates, and you go and talk about conditions under which a check may be dishonored, then you may not get it right. So you need to know the difference. But dishonored check, when the amount in figures do not tally with the amount in words, that could be once there are alterations on the check, there could be. So these are examples of them. But what we're saying that when a check is dishonored, when you write a check, you record in your books as though the money is not there. So if the check is returned, then that will be a reversal of the transaction. So because you don't have that information, That's why there could be a discrepancy when a bank statement is issued and you compare with your bank statement balance. Then we have also issues like credit transfer, where monies are deposited directly into your account. Then that could also lead to that kind of situation. So we're talking of an example of where there are dividends. You have shares in the company and the dividends are paid directly to your account. Then that could also lead to a discrepancy between your bank statement balance and your card balance. And you collect that we have already talked about direct debits. So basically, these are the two main causes: informational difference and timing difference. Any question? Any question? Okay. Now, this is how to Abdul Manan. Bismarck, yes.
Prof, sorry.
Sir, please. Can we say that the difference between the standing orders and the direct debits is the timing?
No, it's one of them. It's one of them. There are several situations. Okay, so for instance, the timing for the standing order, it is for specific period. So on 28, send this to my daughter. Okay, send this amount. But for the direct debits, it could be several times in a month. The amounts could also differ. So it's not only about the time.
Yeah. Okay, sir. Thank you, sir.
Yeah. Okay. Any other question? Oh. Any other question? Okay. Now, we have said that there's a discrepancy between the bank statement balance and the cash book balance. Now, so when you receive your bank statement balance, you receive your bank statement, you compare it with your cash book, okay? And if you collect at the beginning, I was saying that when you receive a check, which is an increase in an asset, you are debiting your cash book, the bank column. But when you send it to the bank is going to credit you. And when you issue a check, you will credit your account because it's a reduction in an asset account. But when you send it to the bank is going to debit you. So if you are comparing, what you are doing is that you're comparing the debit entries in your cash book with the credit entries per the bank statements. Okay, you're comparing the debit entries in your cash book with the credit entries as found on the credit column of the bank statements. Then you are comparing the credit entries of your bank, your cash book, with the debit entries of the bank statements. Now, as you compare them, you will now isolate the outstanding item. So if it is here and it's not there, then it means that there's an issue. If it is there and it is here, there's no an issue. So you can cross them out. Okay? So as you compare the debit entries per the cash book with the credit entries of the bank statements, the items that are there will be items that are outstanding. Then if you compare your credit entries per your cash book with the debit entries per the bank statements, there could be items that are outstanding. Now, these items that are outstanding, recollect that we have mentioned that there are two main discrepancies or causes of the discrepancies. We talked about the timing difference items. We talked about the informational difference items. So when you isolate them, you now have to now determine whether they are timing difference items or they are informational difference items. So if I compare the debit entries with the debit entries per the cash book, the credit entries, I'll identify some items. I need to know whether they are timing difference or they're information difference. Then I'll compare the credit with the debit, the credit of the cash book with the debit of the bank statement, and I'll identify the items, whether the timing or the information difference. Now, once any question, can we continue? If it is informational difference, it means if you had the information, you would have gone ahead to record it. So, for instance, if you knew that the bank has credited you with interest, you debit your cash. Or if you know that the bank has debited you with interest, you know that it's a reduction of your money. So in your cash book, you are going to credit it. Okay. So those items that are informational difference, you are going to use it to adjust the cash book. You are going to complete the cash book with it. But those items that are timing difference, because it's a matter of time, you don't have to adjust your book. You don't have to make any alterations to your book. All you have to do is to wait for them to do it. So you now use the timing difference as a basis of reconciling your cash book balance with your bank statement. So essentially what you do is that you want to agree the two positions. You want to agree the two positions. Any question? Any question? So information or transaction that are informational difference in nature are used to complete the cash book. Then transactions that are timing difference in nature are bank reconciliation. That's it. Yes, Matilda.
Thank you, sir. Please, I'd like to find out about the informational difference. You know that the
Please wait. As I'm going to remove you from the class. Yes, Matilda.
Yeah, please. The traditional banking system that we used to have, you have to wait till the end of the month before you know the transactions that have gone into your account. But the system we have now, we have electronic banking whereby the bank will alert you on some of those transactions. I would like to know whether you can use those alerts to make the entry in the cash. Thank you.
Okay, are you asking me or are you asking the class?
Please, I'm asking you.
Okay, so the class, what do you think? Has there been situations where you have an alert, but when you receive your statement, there's a difference? Yes, Michael.
Okay, thank you, sir. What I would say is, if that system really works and is correct, then I guess it's going to save a whole lot of stress. So we can just go ahead and from whatever that the bank is telling us, we can just use that information. And it's going to save a whole lot of stress. Thank you.
Okay. So when you are going to do the entry, what you do is that you will now print the alert as a source document for the entry. Is that what you're going to do?
Yes, sir. We can do that just in case that at a later time, when the bank finally releases the whole information, we can make some comparisons and make sure that everything is still intact.
All right. Yes, Siba. Yeah.
No problem.
Yes, please go ahead.
Yeah, with that kind of system, there can still be an error. But it's difficult for it to result into a reconciliation. In the sense that since at any point in time you get an alert, so when there's a transaction that you are hoping of or you are expecting of, that hasn't happened, you can call the bank and find out whether that has happened or not. So that because you've not received an alert, they'll prompt you to tell you whether it's because of the time difference or what. So when you receive that information at any time, you know what is happening with your account at the bank. So when you're going to prepare your bank statement, at least the moment you know the balance in your bank statement, you just refer to the alerts they've given you to know whether the balances are the same. If they are not the same, that is where you can prompt them to find out. You can call for them to print out your bank statement from their end so that at least you do the comparison. But at least this will save this heckle of reconciliation issues.
So it means that you don't have to do a reconciliation.
I'm not saying you not do a reconciliation. You do it, but it won't be as stressful as the old system will be, because at the very moment you have your source document already from the bank. So when you're going to prepare your bank reconciliation, you just, because what you call for a bank reconciliation is when there's a difference in the balances.
Yes.
So when you check your cash book and you see the balance in your cash book and that of the bank's alert are the same, then there's no need for bank reconciliation. At the moment there's a difference, that is what will trigger for a bank reconciliation.
Okay, right. Yes, Anne.
I wanted to say, sometimes with the alert, it might come that day, or it might not come that day, or the hour that the thing happened, or it might come the next day. Or sometimes when a transaction is made, it can be reversed. So I don't think the alert is something that should be used straight away. I feel that the statement is better, because the statement you can get at least at the end of the month. But with the alert, because it gives you as and when you make a transaction, and that transaction is made by anyone, so anything can happen. So the alert is not something that you can depend on, because it's not always that it even comes sometimes. Yeah.
Okay, so you can depend on the alert, but you for documentary purposes, you need to do the reconciliation with the statement, the bank statement. Okay. So you have to use the statement to do the reconciliation. And the reconciliation is important because when at the end of the year you are preparing your financial statements, it is what has been reconciled that you are using. And you need the documentation there to do that. All right. Now, so when you are doing the reconciliation, you will add all entries that have increased the balance but had not been recorded in the cash book. Okay, so this will be, for instance, if they are direct debits. Okay, so if they are direct debits, the bank has debited to your account, but you have not done that to your account. Okay, and because you have not done that to your account, it's capable of increasing your cash balance as per the cash book. So if the bank says that there's an interest, so the interest, you have not recorded that, and because you have not recorded that in your books, it has a capacity to increase your balance. So whereas the bank has debited, you have not done the credits. So because of that, your balance payments. And you have your answer. Okay. If you are adjusting the cash book, remember that you can have what we call the T account, and you can also have the vertical presentation. Now, so what we're showing you here now is the vertical presentation. Now, so if you have an item that has the capacity to increase your bank balance, and for which the bank has done that, but you have not done it, then you have to now do it because you don't have that information. So if the bank has gone ahead to credit your account, we say dividends from a bank or from another company. If you knew that, or if they have given you the dividend warrants, you have gone ahead to debit it in your cash because your asset of bank will increase. So anything that has the capacity to increase the bank balance, and for which the bank has done, but for which you have not done, you go ahead and do it. So if we're doing the T account, issues that has the capacity to increase your bank account, you are going to debit all of them. Now, what you need to understand is that we are assuming that the balance as per the cash book is positive. But if it were negative, we would have put it in parentheses, so that anything that the bank has recorded as credit, you are now going to record as debit. Okay, so all of it will now be added, and it will now go to show the total credits. Then you now take away all the bank statement items that you did not have the information, and because of that you have not credited your account. So per the bank statement they would have debited them, then pay your cash book you have not credited them. So you now go ahead to record them. So for instance, if there are direct debits, if there are standing orders, there are bank charges, all of them will now be put together. Then it will, if you deduct it from okay, I should have labeled this as, okay, let me just stop sharing. Sorry, I want to label it so that it's easier explaining it to you.
Right there.
So I just want to label them so I can use it to explain to you. Okay. Now, so what? If you pick your cash book, the balance, the earning balance, which we call as the balance as per the cash book, will be what we refer to as A here. So the A will be the one that is in your cash book. Then you're now going to add all entries that are on the bank statements, which you do not have the information. And again, if there's an error that has decreased your bank balance, all of them will now be added together. So if you do all the entries, so the entries like direct credit and maybe interest that you have received and all that. So if you put all of them together, that will become the B. That will become the B. Now, once you have the B is added to the A. So you have the C, which represents your total debit balances. Then you now, so if we're using the T account, you would have sent these ones to the debits. Now, when you have done that, you take away all entries that have been done correctly and that have decreased your cash balances, but for which you did not have the information, and for that reason, you have not recorded in your books. So we're looking at standing orders, we're looking at bank charges, we're looking at interest charges, we're looking at direct debits, and so forth and so forth. So all of them will now be put together. Then, if there are errors that have increased your cash balance, it means you have to reverse it. So you will now put that there. So if you add them together, that will give you the D. So if you subtract the D from the C, it will give you the updated cash balance as at the date that you are doing the reconciliation. Okay, so this E now becomes the adjusted cash book. And it's adjusted cash book that you are going to use to prepare your reconciliation. Okay, so the next one is to prepare the reconciliation. So the first one, we are looking at the adjusted cash book. And here we are looking at the bank reconciliation statements. Now, if you are doing the reconciliation statements, you are going to add. So remember that we are picking the balance as per the okay, so let me explain to you that when you are doing the reconciliation, you can either reconcile with the bank statement balance, or you can reconcile with the cash book balance, or the adjusted cash book balance. Now, depending on which of the methods that you choose, then the adding and subtraction you ought to be careful with. So if you start with the bank statement balance, you reconcile it to the adjusted cash book balance. Now, so when you pick the bank statement balance, then what you're going to do is to add all uncredited checks. So the uncredited checks, because you have recorded them in your books, you want to add it to what the bank has. So you are going to add all uncredited checks. Then you are going to take away all unpresented checks. Because what unpresented checks have done is that they have the capacity to reduce your balance. So what they are going to do from the bank position is to subtract the unpresented checks from the addition or the bank statement balance. and the uncredited checks. And once you do that, so if we say that this is, say, F. Okay, so from the previous, this was E. So this is E from the other statement. So we are taking the E from the previous statement. And what we are trying to do is to agree the E with the bank statement balance. So let's say that this is F. So what we do is to ensure that the E agrees with the F. The E agrees with the F. And if we are going to agree the E to the F, then it means that all the things that we have done to the E, which includes the uncredited checks, we now have to add it to the F. So if you recollect, the uncredited checks would have debited the cash, but the bank will not have credited us. So if we want to agree the two positions, then we add it to what the bank has. Then the unpresented checks, we have deducted them. Okay, but the bank has not done that because they've not been sent to the bank. And because of that, we deduct it from the bank. And once we do that, the two positions will agree. Okay. We could also use the updated cash book balance as a basis of the reconciliation. So then we are going to start with the adjusted cash book or the updated cash book. If we do it that way, then what we are going to do is that we are going to now add unpresented checks and subtract uncredited checks. So depending on which of the balances that we start, one will be added and one will be subtracted. So take it this way. If we start with the bank statement balance, then we are going to add uncredited checks and subtract unpresented checks. But if we start with the adjusted cash book or updated cash book, then we are going to add uncredited checks. If we start with the updated cash book, we are going to add unpresented checks and take away uncredited checks. Okay. I should have done the other one too, so that it will be easier for you to appreciate. Any question? Any question? Any question? Any question? Yes, Iba.
So,
yeah.
I don't know how to ask the question, but I have to ask. It has become some stuff in our eyes.
Some way.
So, it can be done in a layman's term. At least we'll get it. Probably maybe things that affect this should be done this way. Things that affect this should be done like the bank balance and the cash book. So you want to know if things like, I don't know how to put it, but want to know how things in the cash book, when it's added, how we subtract it here. When this is credited, how we should add debit it here. So at least we get a little bit of fair idea of what is happening. I believe my colleague also share the same line.
Yes, the same. We are in the same soup.
Yeah. Okay, all right. So let's go back to the adjusted cash book. So we can call this as the adjusted cash book. Okay. Now, let me use this one to explain to you. what I said was that if we have two documents here. We have the cash book, then we have the bank statement. Are you okay with that? Yeah. We have the cash book and we have the bank statements. And I've explained to you that what we record at the debit of the cash book will be at the credit of the bank statement. Do you remember that?
Yes.
Okay.
Yes, please.
So, if there's an item that is recorded at the credit of the bank statement, and we identify that it is an informational difference, if we had the information, what would we have done? If we had the information, would have recorded it. Okay, in the cash book. But which side of the cash book?
The credit side.
No, the debit side.
If it's at the credit side of the bank statement, debit. The opposite side.
Debit.
Okay. Now let me explain to you that the balance as per the cash book, it can be positive or can be negative. When it is positive, it means that we have money. If it is negative, which would have put in parentheses, it shows that it's an overdraft. Please mute your microphones. So what we have here as A shows that we have money at the bank. Is that okay? So if we have money at the bank, and yes, Lydia.
Yes, sir. But is money at the bank, should it be debited to your cash book, or it should be credited to your cash book?
Okay, so if we are going in circles, okay, I have told you that bank is an asset. So when an asset is increasing, what would be the asset?
When an asset is increasing,
yes,
then you debit the asset account.
Okay, so a bank is an asset, and you have money at the bank, or you send money to the bank. What will you do?
Okay, so you still debit the bank account.
You debit the bank.
The cash.
The cash.
You debit your cash book. Yeah.
Yes, but the bank will credit you. That's why what we see at the debit of the cash book is the opposite of what the bank statement will show.
Okay.
Okay. So if we receive money at the bank in the form of, say, direct credits, the bank is going to credit us, but we have to debit it. Do you understand that? Because if we receive the direct credits, it's an increase in the bank account. And because bank is an asset, when it is increasing, you debit it. Do you understand that?
Yes, sir.
Okay. So all the credits per the bank statements that are informational in nature must now be debited to the cash book. And you see, we have shown here that A is positive. So if it is positive, it means that any increases must be added to it. So that's why we are showing that if there's a direct credit, if there's a credit transfer to our account, all of it must be added to the money at the bank. That's why we are adding all of it to the A. Do you understand that now?
Yes, sir.
Okay, let me see if I can do this. Okay, so this side will be the debit. Okay, so the DR is at the left, so the CR should be at the right. I'm trying to do it, but it's no problem. Okay, so let's assume that the CR is at the right. So we have the debits and we have the credits. Is that okay?
Yes, sir.
Okay, so your balance as per the cash book will be here. Will be here. Okay, now so if the balance as per the cash book is here, then all the informational difference items that were at the credit of the bank statement will also be where the balance is. Do you understand that?
Yes, sir.
Yes, bro.
Okay, then all the items that have capacity to reduce the bank statements will be here. Okay, so issues like the direct debit, and all that will be at the credit side. So when we finish, we are summing up those at the debits and we are summing up those at the credits. So it's similar to saying that we are summing up all of it so that we have the C. Okay, so we have the C. So the when we are balancing off an account, we haven't done that. But when we sum this up, we are now going to also sum those at the credit up. And the difference is what is going to be the balance as per the adjusted cash flow. Now, per what we have done, we assume that the totals of the debits be more than the totals of the credits. So if the totals of the debits are more than the totals of the credits, then the difference is what is going to be the balance as per the adjusted cash flow, which will show the cash position. Is that okay?
Yes, sir.
Yes, Prof.
Okay. Any question before we move on to the other one? So essentially what I'm explaining to you is that you can use the T account. And if you use the T account, if we have a balance which is positive, it will be at the debit. We are going to add all the information difference items to it, or we are going to record them at the debit. Remember that the information difference items at the credit of the bank statement should be recorded at the debit of the cash. Then the informational difference items at the debit of the bank statement will be recorded at the credit of the cash book. Is that okay?
Yes, Prof.
Yes, Prof.
Hello, are you guys there?
Yes, Prof.
Yes, we are.
Yes, please.
Yeah. Are you confused?
Yes, no, we are not. We are not for now.
We are here.
Okay. This online thing is really tough. It's possible. All right. Now, so let me take it again and take it slowly. Now, what we have done is that we'll be able to identify, we have compared the cash book to the bank statement. Remember that that's the starting point. We're comparing the bank statement with the cash book. And we have said time and again that the items that we report are the debit of the cash book. If we receive a statement, because the bank is going to report it at the credit in their books. So if we receive a check and record it at the debit of the cash book, because the cash or the bank is an asset. So if we receive any check for which we are going to deposit, we should record it at the debit. But when we send it to the bank is going to credit us. So it's the opposite. So don't confuse the two. In the bank's books, what they credit us, in our books, we are going to debit it. Now, so if we compare the bank statement to the cash book, we are comparing the credits items in the bank statement with the debits in the cash book. And we are comparing the credits in the cash book with the debits in the bank statement. And I'm saying that we have isolated items. And the isolated items, some of the items that will be recorded are the credits of the bank statement, which may not have in the cash book, could be direct credits. So if the bank receives a credit on our behalf, they will credit our account. But because we do not have that information, and which we are calling as informational difference, if we receive it, they are going to record it at the debit of the cash book. Is that okay?
Yes.
Hello?
Yes, sir. Yes, please.
Okay. Then, if we issue a check, remember that if we issue a check, it means that the asset of bank is going to reduce. Because if we issue a check or withdraw a check, the money will be deducted from the bank. And per what we have agreed with the accounting operation, anytime an asset is decreasing, so if we issue a check, the asset of bank will decrease. So in a cash book, we are going to credit the cash book. But when we send the check to the bank is going to debit our account. So we'll be comparing the credit of the cash book with the debit of the bank statement. Okay. Now, so if they are debits, if they are credits, if they are debits in the bank statement, what we are going to do is that we are going to report it at the credit of the cash book. So, for instance, if there are bank charges, the bank charges will have to be credited to the cash book because it's a reduction of your monies at the bank. But the bank is going to debit your account. So together, you put the two together, it's now going to give you, or it's now going to help you to determine your updated cash or the adjusted cash. So that is what we use the adjusted cash. Is that okay now?
Yes.
Yes. Okay. Now, once we have done the adjusted cash, remember that we have an updated cash position or the balance as per the adjusted cash. But that adjusted cash book balance will be different from the bank statement balance. And therefore, you need to reconcile the two positions. I.e., try to agree the adjusted cash balance with the bank statement balance. And this is how to do it. I've explained to you that you can either start with the bank statement balance, or you can start with the adjusted cash balance. Either way, it's acceptable. So you can either start with the bank balance as per the bank statement. But if you start with the bank statement, there's a position that the bank has given you. And that position that the bank has given you does not include certain items that you have recorded in your bank statement, which has the capacity to correctly increase your bank. So, for instance, if you receive checks and you record in your books, it will increase your bank position or your bank balance per the bank statement. But because the bank has not got that information, the bank will not have recorded it. So there will be a discrepancy. So if you want to agree the two positions, then what we have done to our balance, we should do the same thing to the bank balance. So because we have credited ourselves with the uncredited checks, we now have to add the uncredited checks to the bank statement balance so that the two positions will agree. Okay, so what we are doing is that we are now adding the uncredited checks, which we have credited in the cash book, but for which the bank has not credited. We are adding it to the bank statement balance. And if we add it to the bank statement balance, the two positions should agree. Then we have deducted unpresented checks because we drew the checks and we gave them out to our clients or customers. But the bank has not done that deduction. So if we want to agree the two positions, the bank must also deduct. And that's why we are taking out the unpresented checks. So if we do that, then the two banks will agree. Okay? Then we will also take into consideration errors. And the errors, there are some that may increase the bank statement balance, and there are some that will decrease the bank statement balance. So those that have been done that will wrongly decrease the bank statement balance, we add them back. And those that have been done that have the capacity to increase the bank statement balance, we subtract them. And it will give us the adjusted coverage position. I think I'm tired.
Yeah.
Any question? Any question?
It's better now.
But if you have questions, let me take the question.
So you are tired.
No, I think
Some of us
Prof, I have a question.
having an accounting listing. So it's really difficult. It's just like a new thing to some of us. That's the honest truth. But I'm just trying to get it, to be honest with you, because I really wish to learn it.
All right. Yes, Siba.
Okay, Prof. Earlier on, you mentioned of overdraft.
Yes.
So I want to find out when it's an overdraft. Is it a vice versa, or how are you going to transact? Go about it.
So if it is an overdraft, it can be vice versa. But in order that you don't get confused, when you have an overdraft, what you do is that you put in parentheses. It becomes negative, and you use the same method. Okay. So if this was an overdraft, would have put this one in parentheses. So it means that this is negative. And whatever figure that we get, we are adding this one to a negative figure. That's the way to do it. Okay, so if it was overdraft, then this will be negative. Overdraft means that you've overdrawn your balance. And because you've overdrawn your balance, it is negative. So if there are credits, the credit will be positive, but we are adding the positive to the negative. That's the way to do it.
Okay, Prof. I have a follow-up. What if the bank balance is rather overdraft?
Which bank balance?
The bank statement.
Yes. If the bank statement is overdraft, so it means that this one will be negative. Okay, it means this one will be negative. So you are adding this positive to the negative.
Prof, my question is, what if the cash book, sorry, Prof. What if my cash book is rather positive,
yes,
but my bank statement is an overdraft?
Yes. So what I'm saying is that if the bank statement was overdraft, this one will be in parentheses to show that it is negative. Then you add this one to it. Because you see, you can turn it. Because you see, when the unpresented check is negative, because we are subtracting. So what some people do is that because it's negative, you go and add the negative to the negative. Is that okay? But it will be confusing. So you adopt one and just put it in parentheses to show that it is negative and just use it. So don't turn it that when it is negative, then we are going to now add unpresented checks. You can do it that way, but it can be confusing. So just follow this format, but put it in to show that it is negative.
Thank you, bro. So meaning everything that we are doing the same, just that we just put the negative side, which is the parenthesis, and we'll do it, the bank reconciliation and the adjustment.
Adjustment, yes.
Thank you very much, bro.
Okay. Any other question? Okay, so what we'll do is that either we'll solve one question in class, the next time we'll meet, or maybe we organize a tutorial and let the TA solve questions with you. I'm sure it will calm your fears down. If you have questions, let me take them now. Otherwise, then thank you for coming.
Hello, sir.
Yes.
So please, I wanted to discuss the tutorial periods with them.
Okay. Yes, Simba, you have a question.
Yes, bro. It seems the slides, if not some of us, or almost all of us, if I may say, have not yet got hold of it. We don't know how we can get it. Because on the Sakai, some of us have tried it on many occasions, but we can't find it.
It's not on the Sakai. I even checked this morning.
You even checked this morning?
Myself, Steve, I checked it this morning and yesterday night and yesterday and this dawn as well. So.
Okay, we'll send them to you.
Okay, thank you very much.
Please, and then videos too as well.
How did we get?
We'll post them on the Sakai, but we can send them to you.
The recordings?
Yes.
Okay. Thank you.
The assignment I used to submit it or it's a different assignment.
Which one?
The assignment is good concerning the
So that's for discussion.
You should go and read.
You should go and read on it. You're not to submit.
Are you the first lecturer?
Assistant. Not lecturer.
Yeah, tell me.
Yes, sir. That was my concern. Either we have to submit or...
No, we are supposed to read.
You submit.
Yeah,
please, through Sakai or...
Yes, through Sakai.
So, sir, please, if I may ask, so we'll be expecting a question on Sakai.
I'll post it on Sakai.
Okay, thank you very much.
Yes. Yes.
Hello, sir.
Yes.
Yeah, please. Did you give any assignment?
Have you been in class?
So it was a reading assignment.
Yes, I'm in class. Oh, okay.
Sorry. Yes, not there. If there was no question, why would you now say that it's for reading? Yes, not there.
Yes, sir. Sorry. I don't know if anybody here can help me, but I am unable to access the document on Sakai. Actually, just 2 of my courses show on Sakai.
You have to send a mail to the office. The office, and they will help you do that.
Sorry, please. When you said the office. Oh, okay, all right. Thank you, sir.
Okay, bye-bye.